we're seeing a very strong earnings recovery. It's one of the strongest we've probably ever seen, to be honest with you. The decline in earnings last year in the midst of the pandemic was earnings were down about 25%, and they fully recovered in aggregate over the last 12 months. So in terms of speed and size, that is the biggest recovery and the quickest recovery that we've seen in the history of the ASX. So quite remarkable, and it's being led by economically sensitive sectors. And we think that that's where, in this environment, where we're going to see ongoing recovery and opening up as the vaccines are rolled out and policy support is maintained, we think economically sensitive sectors are going to remain attractive and where investors should be focusing their attention. The big sectors in Australia, the banks and the miners have really led that. They account in fiscal year 21 at an aggregate level for around half the profits of the ASX, and they've enjoyed very strong recovery. So consistent with that economically sensitive theme, those sectors are really leading the charge, and we think that they will continue to do well. They're continuing to recover in the case of the banks, and in the case of the miners, really benefiting from very high commodity prices, which we think will structurally stay elevated for a period of time. Well, we think that dividends are certainly returning because that earnings cycle is so strong. And one of the key themes going into the pandemic was that the Australian corporate sector was quite lowly geared, and that the banks were very well capitalised. And so what that meant is that these companies were able to, in broad sense, ride out the pandemic relatively well. They were well supported by recovery in financial markets. And so yes, there was some pain there in the short term in terms of dividends being held back. But as the recovery has progressed, we think dividends again are definitely back on the scene. And yields on term deposits, we've never seen them at these levels in Australia before. So the attraction of dividends is actually heightened going forward. So we think companies that are generating strong cash flows, paying good dividends, will certainly be back in favour. Traditionally, the banks has been the area where investors have sought those dividends. They've been comfortable with the sustainability of that. That's been questioned when they had to really hold them back last year, but we think the recovery in dividends is going to be quite healthy and also more sustainable going forward because the banks have been able to reset their payout ratios towards more sustainable levels. So we think that that's a positive. But a newer area we think where dividends will be quite attractive, albeit more volatile, will be from the mining companies. The mining companies are in quite a different position to any time in their history. Their balance sheets are excellent. They're really not investing at the same levels that they used to. And their cash generation is sufficiently strong that they're just paying those excess profits out to shareholders. And we think that's not just a cyclical trend, but a structural trend where dividend rates will be much higher. So given where where commodity prices are right now, BHP, Fortescue and Rio Tinto are likely to be on double-digit dividend yields over the next 12 months, and those dividends are fully franked. And if you look at it historically, the yield from those types of companies were relatively low, around the 2% or 3% sort of level, but they've now moved up sustainably into higher levels, probably more like 5 or 6%, and then when the prices are very high, they can go to these double-digit levels and pay out those profits to shareholders. In fact, over the next 12 months, it looks like the aggregate dividends that BHP, Fortescue and Rio will pay just to ASX shareholders, so ignoring the foreign shareholders, ignoring people like Andrew Forrest, those dividends just to those shareholders will exceed the dividends that the banks will pay to all of their shareholders on the ASX. So it just gives you a sense of the quantum and therefore the attraction of high commodity prices and the ability to extract dividends for shareholders from that environment. Well, there are companies that are starting to come through. Depending on where the opportunity is in the particular commodities. So one commodity that's looking quite favourable, we think both cyclically and structurally, is copper. A company that's well positioned in that space is Oz Minerals. They're one of the leading copper exposures on the ASX. It's very hard to find pure copper exposures around the world, and so this is one of them. And they have a very attractive growth profile, which means that they're in great position to be bringing growth in volumes on at a time when we really need those, particularly given the demands for electrification from decarbonisation, etc. So that's one that we would highlight as a company that's been around for a while, but is really establishing very strong growth credentials. There are potential risks, but we think they're relatively low as far as China goes with the commodity sector. And in fact, China's influence on the commodity sector, we think, is going to be much more positive than negative because of the demand growth and the size of the Chinese economy. That's an ongoing theme for commodities that will continue. The biggest commodity that people focus on as a potential risk would be iron ore, because of the sheer size of it for Australia as an export to China. But we tend to think that risk is not a very high one in terms of disrupting that trade, and it's really because China's steel industry doesn't have alternative sources of supply, and although they may strategically look to develop alternative sources of supply, it will take them a very long time to do that. So certainly over the next 5, maybe 10 years, it would take a long time for China to diversify from Australia in terms of its iron ore supply. And so the alternatives for China to disrupt its steel industry by, in a sense, exacting some type of punishment on Australian iron ore is a very high price for both parties to pay, and we don't think it's very likely to happen.